Good morning. This is Dr. Sharma. I'm continuing with my video presentations. This is chapter number 4. It is completing the accounting cycle, and it deals with everything that we have done from chapter 1 to chapter 3. So it's kind of a combination of all the 3 chapters we have learned so far, and then it will be adding 2 or 3 things into this chapter. We'll be talking about them as they come by. Now, the learning objectives for this chapter number 1 is describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance and then to the financial statements. So in the previous chapter, chapter number 3, we learn about how we will be doing the adjusting entries and then posting those adjusting entries in order to calculate the adjusted trial balance. And I also showed you how you do a worksheet till the adjusted trial balance. And from the adjusted trial balance, we could draw up the financial statements that we have learned, the income statement, the statement of owner's equity, and the balance sheet. Next would be to prepare the financial statements from the adjusted account balances. And then the new thing that we are learning in this chapter is to prepare closing entries. We'll be talking about them. There are some temporary accounts which need to be closed every accounting period so that we can start afresh in the next period. Then we'll be talking about the entire accounting cycle, and I'll be illustrating the accounting cycle with the help of an example. And then we'll be also talking about the fiscal year and the natural business year. And we'll be talking about the working capital and the current ratio in evaluating a company's financial position. In previous chapter, we learned about the horizontal analysis, the vertical analysis, and then this chapter we'll be talking about the working capital and the current ratio to evaluate the financial condition of our business. The first learning objectives talks about the flow of accounting information from an unadjusted trial balance into the adjusted trial balance and then ultimately to the financial statements. As you can see in this exhibit, what we do is we prepare a spreadsheet, that is a worksheet, which has columns for unadjusted trial balance. So first it has a column for account title, that's the first column. The second column is the debit column for the unadjusted trial balance. The third is the credit column for the unadjusted trial balance. Then the fourth column you can have reference for the adjustments, and then next would be the debit column for adjustments, and after that you can have a reference column for the credit column of adjustments, and then the credit column of adjustments, and then you can have a debit column for adjusted trial balance and a credit column for adjusted trial balance. So in essence, you will be having one column for writing the titles of the accounts, and then 2 columns for unadjusted trial balance, 4 columns for the adjustments. 2 of them will be used to write the references and 2 of them for debit and credit. And then finally you will have 2 columns for the adjusted trial balance. But in case if you want, you can avoid having a reference column and use only 2 columns for adjustments. Now, once we have populated all the information in that spreadsheet, what we can do is we can transfer the information into the income statement. The first thing that we will be preparing is the income statement, and we have learned in the first chapter that the income statement is prepared by populating the revenues first. So you'll pick up the revenues and then total the revenues, and then list the expenses in the descending order with the miscellaneous expense as the last item, and then add up the total expenses calculate a total. The difference between the total revenue and the total expense is the net income. Now that net income goes into the statement of owner's equity. Now please understand, the owner's equity will always start with the capital at the beginning of the period. Now if it is a new business, the capital will be zero, and then will include the investment during that particular period. So if it is a new business, you'll have investment. Even old businesses, sometimes owners bring additional investment, and then you will be adding the net income to that investment and calculating the total inflow of money, and then from that you will be subtracting the withdrawals. So that will give you an increase or decrease in the owner's equity. So add that increase or decrease in owner's equity to the beginning capital, and that would give you the ending capital of the owner. So then what we do is we prepare a balance sheet. Now, while preparing a balance sheet, we'll be preparing a classified balance sheet in this chapter, slightly different from what we have learned in chapter number 1. Now, in case of a classified balance sheet, what we are going to do is we are going to bifurcate current assets and long-term assets. So current assets include all those assets that are used for a period within a year, and or which provide you benefit for that particular period, and any long-term asset that gives you benefit for a longer than 1 year period is considered as the property, plant, and equipment. So under that we'll be listing all those assets. And similarly, on the liability sides also, we'll be doing the same thing. We'll be listing the current liabilities, and then we'll be having the non-current liabilities. So in this area, we'll be having the current liabilities. As you can see, accounts payable, wages payable, unearned rent have been listed as current liabilities, and in this problem we didn't have any long-term liability, so the long-term liability area is left blank, and then we add up the total liabilities. If there are long-term liabilities, we add up the current and the long-term. That would give you the total liabilities. When it comes to owner's equity, of course, we'll be bringing that information from here to the owner's equity section, and then of course we'll add up and get the same total. So that is how you would be preparing the flow of information from an adjusted trial balance into the financial statements. Now, the order in which we'll be preparing the financial statements is always fixed. Start with the income statement, statement of owner's equity, and then go down to the balance sheet. Now, continuing with the flow of accounting information, this is a format of the worksheet that I just explained to you. On the first column, we have accounts, that is the title of the accounts that we'll be listing them, and account balance are listed in the unadjusted trial balance column using the ending balances that are found in the general ledger before any adjustment has been done. So then you will have next two columns where you'll be writing the adjustments. Of course, as I said to you, the adjustment column can have four columns, two columns each for references and two columns for amounts. But for the amounts, you'll have two columns, and then you will be having adjusted trial balance. In the, of course, the adjustment trial balance is calculated by taking into considerations deferrals and accruals in the adjustments. So that's how you calculate that. Now, adjustments, of course, are combined with the unadjusted trial balance, and the adjustments, as I've been saying to you in the previous chapter as well, I did a problem with you. The debit in the unadjusted trial balance should be added to the adjustment to calculate the debit column in the adjusted trial balance. A debit on the adjusted trial balance and a credit in the adjustment should be subtracted to calculate the balance in the adjusted trial balance. The balance, whenever the debits and credits are different, you'll have to always look for the column which has the higher amount. That would be the amount of balance in the adjusted trial balance. Then once you have the adjusted trial balance, what we do is we extend our worksheet to income statement and the balance sheet. In the income statement, we'll be taking all the revenues and expenses balances as shown in the adjusted trial balance. And then in the balance sheet columns, we'll have two columns in the balance sheet: all asset, liability, owner's equity, and drawing balances in the adjusted trial balance column are extended to the balance sheet column. So that is how we'll be preparing the worksheet. So this is a format for the worksheet. Now, next learning objective deals with preparation of financial statements from adjusted account balances. First is the income statement, as I have been talking to you about it. The income statement is prepared directly from the income statement or adjusted trial balance of the end of the period spreadsheet, that is the worksheet that I just explained to you, beginning with the fees earned of 16,840 in our example. So first thing that we'll do is we'll be preparing an income statement. As you can see, what we have done is from the financial end of the period, that's the worksheet, we have taken out the fees earned 16,840. To that we have added the rent revenue of 120 and calculated the total revenue to be 16,960. And then we listed all the expenses with the miscellaneous expenses as the last in the descending order, and added the total expenses to be 9,855 to calculate a net income of 7,105. So that will be the income statement part. Then what we do is we do the statement of owner's equity. As I have said to you earlier, the first item presented on the statement of owner's equity is the balance of the owner's capital at the beginning of the period. Now, this balance could be a zero if it is a new business, because new business is just started, so we don't have a beginning balance. Whatever amount of money the owner brought this period will be considered as investment made during the period. So if you look at this statement of owner's equity, what we have done is we started with the zero because this is a new business. The business was started by investing $25,000 by the owner, Chris Clark, and then we have brought down that net income of 7,105 from the income statement, added these two together to calculate 32,105, subtract the drawings or less the withdrawals, 4,000. That would give you an increase in owner's equity of 28,105, plus this zero here, that the beginning capital will give you 28,105. That will be carrying forward to the balance sheet. So in the balance sheet, of course, as we know, we'll be preparing the balance sheet directly from the balance sheet column in the worksheet, or if you have only the adjusted trial balance column, we can also do that. But in our chapter, we'll be doing the worksheet, so therefore we'll be bringing all the information from the worksheet balance sheet column and put them in a particular order in the balance sheet. We start with the cash of 2065. As you can see, as I said to you, in this chapter we will start preparing the balance sheet as a classified balance sheet. Under classified balance sheet, you can see we have a subheading under the assets, current assets. Under current assets, we'll be putting all those assets that give you a benefit for a period of 1 year or less, starting with cash and accounts receivable, supply, prepaid insurance, and if a company has an inventory, that will be part of this current assets as well. And then you add the total current assets. So that'll be the total, you'll be getting that. And then next heading would be the property, plant and equipment. Now in case if the company has some investments, we'll be putting in between the current assets and the property, plant and equipment. So the land would be 20,000 and office equipment is 1800, and there is a depreciation of 50, so we subtract and we get a net amount of 1750, and total will be 21,750. That's 20,000 of land, and office equipment is 1,750. That'll give you a total asset of 29,495. On this side, on the liability side, we'll again have the current liabilities. These are liabilities which need to be paid within a period of 1 year. The examples are accounts payable, wages payable, interest payable, notes payable within a period of 1 year, and or unearned rent, any revenues that you have received in advance, all that will be the current liabilities. And if you have a long-term liability, we'll be writing here as a heading long-term liability, and under that we could list the, now long-term liability could be a mortgage payable or a bonds payable, so that would be listed as a long-term liability. Here in this problem we don't have it, so that's why we add all the current liabilities and get the total liabilities. Then in the owner's equity section, we bring down the 28,105 we calculated in the statement of owner's equity and add up these to get the same total of 29,495. Now, as I was talking about classified balance sheet, now what is a classified balance sheet? It's the same kind of a balance sheet, but what we are doing is we are expanding the balance sheet by adding some subsections for current assets, property, plant and equipment, current liabilities and long-term liabilities. So we'll have to make that adjustment in the balance sheet. Now the examples of current assets are cash and other assets that are expected to be converted into cash, sold or used up usually within a year or less. So that is the threshold. Through the normal operations of business. And the examples are cash, accounts receivable, notes receivable, supplies, um, and any inventory that you can have. Next would be the notes receivable. Notes receivable are written promises by the customer to pay the amount, the note, and possibly interest at an agreed rate. So that is an asset. Now, of course, if it is a long-term one, that is considered as an investment. If it is a short-term one, that is a current asset. Now, the fixed assets, the property, plant, and equipment, they are also called as planned assets or sometimes called as fixed assets, but we normally use the heading property, plant and equipment that include assets that depreciate over a period of time. Land is an exception since it is not subject to depreciation, but it is included under the property, plant and equipment. Now the account headings under that fixed assets would be equipment, machinery, buildings, land. Next heading is the current liability. As I have said to you, those are liabilities which are payable within a short period of time, that is usually 1 year or less, and that have to be paid out of the current assets. So those are current liabilities. Examples are accounts payable, wages payable, interest payable, unearned fees. So these are your current liabilities. And next heading would be the long-term liabilities. Liabilities not due for a long time, usually more than a year, are called long-term liabilities. Long-term notes payable or mortgage payable. Now here there is a small concept that you have to remember. Sometimes, like we do that mortgage, we take for a 15-year period, but 1 year, whatever is paid or payable within 1 year will be considered as a current liability, and the remaining will be considered as a long-term liability. Please understand, supposing if I have taken 150,000 mortgage for 15 years, each year I am supposed to pay 10,000. So the 10,000 for this year will be considered, if supposing this is the first year, 10,000 will be considered as the current liability, and 140,000 will be considered as a long-term liability. So that's how we would classify that. And sometimes bonds payable also will be that way. So these are your current, long-term liabilities. Next section is the owner's equity. Now, owner's equity we have been talking about. This is the owner's rights to the assets of the business, and then owner's equity will be added to the total liabilities to calculate a total liabilities and owner's equity, which should be exactly equal to the total assets on the asset side. So that is how we will be understanding uh, about the owner's equity section. And next learning objective is preparing the closing entries. So let me just take these learning objective, and then we'll proceed further in the next presentation. The closing entries, now accounts that are relatively permanent from year to year are called permanent accounts or real accounts. Now these accounts are carried forward from year to year. Supposing you have a cash, you have a land, you have inventory, you have plant and machinery, all those accounts will be carried from one year to another. Capital, drawings account, owner's equity accounts, all that will be carried forward to future years. But there are some temporary accounts which are only good for that particular period. Those are known as also nominal accounts. Temporary accounts are not carried forward because they relate only to one period. That is, supposing if you have paid expenses for the telephone, you have used them, and then they are not good for future period. But if you have prepaid some expenses, of course they will be considered as permanent and not closed. But if the benefit has been derived, they are temporary accounts. Now these are accounts like, I give an analogy of going to a gas station. If you go to a gas station and fill your tank, as soon as I pay that money, it should be reset to zero. Otherwise, what will happen is whatever gas I put in my car will have to be paid by somebody who is coming behind me. So, similarly, in accounting, also for 2014, if there are any transactions that give benefit only for 2014, they have to be closed. If I don't, then they will be carrying forward to 2015, and that would be a wrong thing to do. You will be violating the matching principle. So therefore we'll have to close all the temporary accounts. Now in order to report amounts only for that particular period for which they have received the benefit, they should be zeroed out at the beginning of the next year. So that's why we'll have to close them to do that. Now, to achieve this, the revenue and expense account balances are transferred to a temporary account known as income summary account at the end of the period. Now, please understand, income summary is only a temporary account that is opened. The balance of income summary would be either a net income or net loss, because we know revenue minus expense would be a net income. So that is why if you transfer revenues to the income summary and also expenses to the income summary will show a net income or a net loss. It would be a net loss if the expenses are more, and it would be a net profit or net income if the revenue is more. Now, once the purpose of closing the revenue and expenses is achieved, the income summary will have to be closed by transferring to the capital account. And then another account that needs to be closed is the owner's drawings account. That will be again transferred to the owner's account, and then we will be closing that drawings account. The entries that transfer these balances are called the closing entries. So this is kind of a summary of the closing process. What we do is we have an income summary account in the middle. From the right, we bring all the revenues and put it in the income summary account. we bring the expenses and put them all on the income summary account. Then the income summary itself will be closed by transferring to the owner's capital, and then the drawings will be closed by transferring to the owner's capital. So that is the process. Now please understand, expenses always have a debit balance. So if expenses have a debit balance, if I want to close them, I will be crediting them. If I credit the expenses, I will be debiting the income summary. Revenues always have a credit balance. So if I want to close them, I have to debit them, and I will be transferring to the credit side the income summary account. So as you know, each journal has to have a debit and a credit. So to close the revenues, I will be debiting the income summary and I will be debiting the revenues and crediting the income summary. For expenses, I will be debiting the income summary and crediting the expenses so that I close them. Then I close the income summary account. It depends, the journal depends upon whether I had an income or a loss. If it is an income, I will be crediting the capital account and debiting the income summary. If it is a loss, I will be debiting capital account and crediting the income summary. So that would be how we'll be closing that. And then the drawings account will be closed by transferring to the owner's capital, and the drawings account is a debit balance account, and if I want to close it, I will be crediting it and I'll be debiting owner's capital in order to close the drawings account. So that's how we'll be doing the closing entries. Now, as I said to you, income summary is a temporary account that is only used during the closing process. At the end of the closing process, the income summary account will have a zero balance and it needs to be closed. Sometimes income summary is also called as a clearing account because we are trying to clear out the temporary accounts by using this account. So this is the process as you can see. Now what we have done is we have fees earned and rent revenue, two revenues account, and we will be closing them by transferring to the income summary credit side, and revenue accounts will be debited as you can see. So debit each revenue account for its balance and credit income summary for the total revenue. So that's what we have done figuratively. And next is we'll be debiting the income summary for the total expenses and credit each expense account for its balance. So that is what we have done, and we bring it to the debit side of the income summary. Now the third thing is I am closing the income summary because income summary has a balance. So we'll be debiting the income summary for the amount of its balance, net income, and credit the capital account. So that's what we are doing. Now if it is a net loss, it will be opposite, so you'll have to understand that you'll be crediting the income summary and debiting the capital account if it is a net loss. When will that happen? When you have more expenses than income. Okay, that is how we close the third one. And the fourth one is I will be debiting the capital account for the balance of the drawings account and credit the capital account. So that is how I will be doing and closing. So these are the four entries that you will do every time you have to close your books of accounts. So these are your closing entries, and we'll be posting these closing entries and writing as closing entries in the item in each and every ledger. So you can see that was part of the step number one: debit the revenues, credit the income summary. Step number two, debit the income summary and credit the expenses individually. And then since the income summary has a net income, we'll be debiting the income summary and crediting the capital account. And if it is a net loss, we'll be doing the opposite. Capital account will be debited and income summary will be credited. And in case of drawings, I'll be debiting capital account and crediting drawings to close the drawings account. So after I do that, temporary accounts closing entries are posted, and all temporary accounts will now have a zero balance. So if you see, cash is a permanent account, so we don't close it, so that's why it has a balance. Land equipment is also permanent, and then accounts receivable, supplies, accounts payable, wages payable, unearned rent also permanent. Prepaid insurance, Chris Capital drawings, you can see the drawings account have been closed out and the balance is zeroed out. So that is here, as you can see on the item, there is a closing. And in case of capital, of course, it's a permanent account. We don't close it, but we bring some items into it. Rent expense is a temporary account. We have closed it and zeroed out. So similarly, other income summary has been closed out with the zero: fees earned, depreciation expense, utilities expense, rent revenue, wages expense, supply expense, insurance expense, and miscellaneous expense have all been zeroed out. Once we do the closing entries, we'll be preparing a post-closing trial balance to verify that the ledgers in the balance at the beginning of the next period are tallied. So that is how we'll be preparing a post-closing trial balance. This is the format. As you can see, you don't see a revenue account, you don't see an expense account, you don't see an income summary or a drawings account. So these are all your permanent accounts, and that is what the post-closing trial balance will have. That's all for this presentation. I'll pick up from the learning objective number 4. Thank you very much for listening to the presentation. I hope they are useful to you.